Kia ora, and welcome to the Cotality Property Market Update for Haratua, May 2026. The momentum we saw across the market earlier in the year has effectively flattened out. The April Home Value Index shows national property values grew by a marginal 0.1%, a clear sign that the initial 2026 recovery has hit a roadblock. The national median value now sits at $809,000. While we have seen 0.6% growth over the last quarter, we remain 0.8% below where we were this time last year. The HVI data shows a distinct split between the islands. In Te Ika a Maui, the North Island, our major hubs of Tamaki Makaurau, Auckland, and Te Whanganui-a-Tara, Wellington, have both dipped back into negative territory. While the monthly drops are minor, they illustrate a lack of conviction in those larger markets. While much of Te Ika a Maui, the North Island, is treading water, Whangarei, Tarawhiti, Gisborne, and Tauranga recorded notable increases in value this month. Conversely, Hiratonga, Hastings, saw a 1% dip. In Te Waipunamu, the South Island, the trend remains more consistent. Ōtautahi Christchurch saw a 0.4% lift, while Ōtepoti Dunedin recorded a 0.8% increase for the month. The most active segment remains first home buyers. Our latest report, released with Westpac, shows this group is actually finding better value in the current climate. We're seeing a high proportion of first home buyers securing standalone houses rather than shared wall units, with the median price paid sitting at $720,000. They aren't just buying at the bottom of the ladder, they are leveraging low deposit allowances, with more than half of all first home buyers entering the market with less than a 20% deposit. Westpac's data shows the average loan to value ratio has climbed to 81%. And interestingly, the average age of a first home buyer has ticked down from 36 to 35. Meanwhile, mortgaged multiple property owners have settled into a rhythm, accounting for roughly 24% of sales. However, their growth has stalled, with rents remaining soft in some areas and operating costs rising, compounded by $100 oil. The yield gap is becoming harder for many to justify. For existing owner-occupiers, the mover market remains in a standoff. While the Q1 unemployment result of 5.3% was lower than many expected, it likely represents a false dawn. Underutilisation remains high, and with the cost of living crisis exacerbated by high oil prices, job security has once again become a deterrent for those considering a relocation. For many households, the perceived risk of taking on a new mortgage in an uncertain job market currently outweighs the benefits of trading up. The reason for this widespread caution becomes clear when we look at the broader economic picture. We are now into the third month of disruption in the Strait of Hormuz. For the banking and real estate sectors, the focus has shifted entirely to how the Reserve Bank balances spiking inflation against an economy that is still incredibly fragile. The market is already pricing in earlier increases to the official cash rate, but there is significant debate. Tightening policy now risks kicking an economy that is only just rising from the canvas. While we expect a hold from the Reserve Bank this month, the July decision is very much live. It's worth noting that in their latest financial stability report, the Reserve Bank noted that house prices are already at the top end of the sustainable range. This suggests that even before the latest global shocks, there was limited capacity for further value growth relative to current incomes and interest rates. Ultimately, we remain at the mercy of the geopolitical situation in the Middle East. The longer the oil supply remains choked, the more pressure builds on businesses, consumers, and mortgage holders. Until we see a resolution in Iran, the market is likely to remain in this holding pattern. Stay up to date with all the latest movements and download the latest first home buyer report at cotality.com/NZ. Follow Cotality NZ on social and subscribe to the New Zealand Property Market Podcast on your preferred platform. Mā te wā.